Welcome to the deep dive. Today, we're cutting straight through the headlines of what looked, on the surface at least, like a truly triumphant, risk-on day in the market.
It really did.
We've taken your collection of cross-asset market reports, and our mission today is to figure out the core truth. How convincing was this massive bullish move, really?
It's the essential question, isn't it? Because the major indices were just soaring. But when you dig into the material, our analysis shows some deeply structural pockets of skepticism.
Right, lurking just beneath the surface.
Exactly. So for you, the listener, what we're trying to determine is if this rally was a sustainable foundation or, maybe just a sugar rush.
And that central bullish narrative was incredibly powerful today.
It was. U.S. equities rallied and rallied strongly. It was driven almost entirely by shifting expectations for future monetary policy.
The soft landing.
The market is aggressively pricing in that soft landing scenario. The idea that inflation cools, interest rates start to drop soon, and somehow we manage to avoid a major recession.
And that optimism, that really became the dominant trade of the day.
It really did.
Okay, so let's start with the closing tally. The numbers themselves, they immediately signal where the conviction lies.
They do.
The S&P 500, it closed the day at $6,850.92. That's a gain of 0.65%, a strong, solid performance.
Solid, absolutely. But the leadership is what tells the real story.
Ah, okay.
You had the NASDAQ composite, full of those high-growth tech behemoths. It led the entire charge. It finished up a massive 1.9%.
Wow, okay.
But then you contrast that with the Dow Jones Industrial Average, the old-school benchmark for industrial and cyclical names.
And it lagged.
Lagged significantly. It was up a much more modest 0.30%.
That divergence is just crucial. So when the NASDAQ is racing ahead of the Dow like that, what exactly are investors voting for?
They're voting for future policy relief. It's that simple. When the NASDAQ outperforms, it signals a market preference for long-duration assets.
Companies whose big profits are projected years down the road.
Precisely. And the immediate benefit of anticipating falling bond yields is that it reduces the discount rate on those future earnings, making tech stocks much more valuable right now.
So it's like the NASDAQ is cheering for lower rates, while the Dow is kind of saying, wait a second, what about the actual economy right now?
That's a perfect way to put it. The Dow's lagging performance suggests that this enthusiasm isn't universal. It's not really there for the financial and heavy industrial sectors that need robust, near-term economic activity.
And the close was near the session highs.
Which is another key point. It confirms that the belief in easing policy held strong all the way through the trading day. The buyers didn't get cold feet before the bell.
Okay, so the why. What was the core driver behind this whole move?
The direction today was set, unequivocally, by one single data release this morning.
Which was?
The softer-than-expected preliminary data from the Producer Price Index, the PPI.
Okay, so for anyone who might not be deep in the weeds on this, remind us why the PPI, the Producer's Price Index, matters so much right now, maybe even more than the CPI.
Because the PPI tracks upstream costs. It measures prices received by producers for their goods, so it's a key forward-looking indicator for inflation.
Right, because what manufacturers pay today
is what consumers are likely to pay tomorrow. So when that PPI number comes in cool, it suggests the future inflation pipeline is already slowing down.
Okay, let's unpack the direct impact on the stock market. A cooler PPI immediately told investors, what about future profitability?
This is the crucial linkage for valuations. A softer PPI suggests that future input costs for manufacturers are going to ease up.
Less expensive raw materials, cheaper components.
Yes. And this anticipated reduction in operational headwinds, it provides an immediate effective boost to future corporate earnings estimates.
So companies don't even need to raise their prices to hit profit targets if their costs are just coming down on their own.
You got it. Investors immediately started positioning for improved profit margins across the board.
And this data point, combined with all the central bank chatter?
Right, the commentary suggesting patience rather than urgency on rates. It just solidified the belief that the rate hiking cycle is definitively over. Today, the debate shifted from if rates will be cut to just when.
Okay, here's where it gets really interesting for me. This is where we stop looking at the shiny index numbers and start checking the rally's structural health.
The market internals.
Exactly, because this is where the source material flags a major contradiction. Let's talk market breadth.
Okay, so we observed significant concentration risk today. if you look at the ratio of advancers versus decliners.
The AD line.
Right. It was about 1.2 advancers for every one decliner. So, I mean, it's net positive, yes, but that's surprisingly tepid given how much the S&P climbed.
Wait, hold on. If the S&P is up 0.65%, why didn't the advancers just crush the decliners? Shouldn't a real consensus rally be broad?
It absolutely should. And the fact that it wasn't,
ahead.
well, that tepid breadth implies the rally was fundamentally narrow.
Driven by just a few big names.
Disproportionately driven by the massive weighting of a small cohort of extremely large cap companies. The absence of broad participation from smaller caps suggests, an underlying structural weakness.
That feels like a warning sign. Okay, so now let's bring in the fear gauge, the VIX. The VIX closed at 14.50. That's a moderate daily decrease, about 4.5%. So a lower VIX means less fear.
Textbook definition, yes. But here's the problem. We see a critical breadth VIX divergence.
Okay, explain that.
Despite the strong S&P rally, the VIX level, 14.50, remained well above its 52-week low of 12.7.
Which tells you what?
It tells you something about the professional money. The institutional options traders, the sophisticated risk managers, they're still pricing in an elevated level of expected turbulence.
So the enthusiasm we saw in the headlines, that was tempered by some cautious risk management happening in the derivatives market.
Exactly. The pros, the people who get paid to hedge risk, they still see this narrow rally as being potentially vulnerable to a reversal if that policy narrative stumbles.
Fascinating. So that macro narrative, the whole soft landing and lower rates thing, it clearly translated into some very specific tactical decisions.
Oh, absolutely. A powerful shift toward growth over value.
Who were the big winners?
Technology led the way. It was up 1.55%, followed by communication services, up 1.05%, and even real estate, up 0.90%.
All sectors that thrive when long-term borrowing costs drop.
That's the common thread.
And then the mirror image, the worst performers. These are sectors that should be happy on a risk-on day. Energy was down 0.35%, financials down 0.10%.
And consumer staples barely moved, just up 0.05%.
Okay, explain the causality there. Why did financials suffer when the indices were so green?
It's the mechanics of the policy shift. The anticipated drop in future rates caused long-term yields to fall faster than short-term yields.
So the yield curve flattens.
The yield curve flattens, and banks make their money on that spread, the difference between what they borrow short-term and lend long-term. When that curve flattens, their net interest margin, their NIMs,
It gets squeezed.
instantly squeezed. It's a direct pressure on their profitability. That underperformance was pressured by commodity moderation. Flat oil prices, well, they signal a potential slackening of industrial demand, which aligns perfectly with that cooling economy narrative.
So if the economy is slowing just enough for the central bank to cut, you don't necessarily want to own cyclical energy stocks?
You've got it.
All right, intermarket analysis. This is vital for avoiding false signals. We have to check if the bond market and commodities actually agreed with this equity rally.
And for the most part, they did agree with the policy trade. The bond market, in particular, strongly validated the shift.
That's so.
The U.S. 10-year Treasury yield closed at 4.45%. That's down 5 basis points. That drop confirmed a genuine decrease in rate hike expectations.
Okay, that's a big green flag.
Also supportive, the U.S. dollar index, the DXY, closed down 0.2%. That signals reduced flight to safety flows, more global risk appetite.
So the two most important validation signals, falling yields and a softer dollar, they were both green for stocks. But the sources flag one major contradictory signal.
Gold.
Gold closed higher, up 0.45%. This is risk on the S&P, and a safe haven, gold, rising together. That doesn't really add up if this is a rally driven by pure, unbridled economic optimism.
This is the nuance you really need to carry forward. When gold and the S&P 500 rise at the same time, it tells us the rally isn't driven by pure optimism for sustainable, accelerating growth.
It's driven by something else.
It's driven by a search for real assets.
Let's explain that. A search for real assets. What does that imply about what investors are afraid of?
It implies that investors are not thrilled about putting their capital into cash. They're afraid that inflation will erode its value even if rates don't rise any further.
So they're moving capital out of things like bank deposits.
Or money markets, and moving it into instruments they see as having tangible value, whether that's equities based on future earnings or gold as a classic store of value. The rally is rooted as much in fear management as it is in genuine enthusiasm.
It's a risk-on move born out of skepticism toward cash.
Exactly.
Okay, let's bring this down to the micro level now. How do fundamentals interact with these big macro themes? The top loser today was a hypothetical industrial manufacturer. It fell 7.8%.
And that sharp decline was driven entirely by a major analyst downgrade. The note cited anticipated margin compression.
And crucially,
Crucially, the downgrade linked this specifically to the rising PPI for intermediate goods, the exact type of input costs that are going up for some businesses.
so even while the headline PPI is soft, pockets of inflation still exist.
You do. And the problem for this specific company was its limited pricing power. They couldn't pass those rising costs onto their customers.
Which means their margins get crushed, and that instantly overrides any positive sentiment from the broad market rally.
It's a direct, painful link between macro data and micro performance.
So now we shift to the immediate forward look. Tonight, we have after-hours earnings for a major semiconductor manufacturer. This feels like a huge test.
It's an extremely high-stakes test for the entire tech rally we just saw, because the options market is already pricing in massive potential volatility.
What are the numbers?
For you, the learner, the metric to watch is the expected percent move. The options market is pricing in a move of 7.5% in either direction for this stock post-earnings.
7.5%. That's huge. That high implied volatility. It just signals extreme uncertainty about capital spending plans and global chip demand.
And finally, tomorrow's economic data will immediately test today's entire narrative.
What are we watching?
We're watching consumer confidence at 10:00 a.m. Eastern, and before that, advanced durable goods orders at 8:30 a.m.
And a sharp decline in durable goods would actually confirm the economic cooling needed for rate cuts, right? It would validate today's move.
It would. But a strong beat in either of those indicators, especially high durable goods orders, suggests the economy is still running hot.
Which would shatter the soft landing hope.
Instantly.
Yeah.
It would pressure tech valuations and could potentially reverse everything we saw today.
So to summarize the core takeaway here.
Today was a successful exercise in pricing monetary policy relief. It drove a powerful but very narrow tech-led rally.
So what does this all mean for you? The rally is, well, it's fundamentally validated by the bond market's action. But that narrow breadth and the VIX's lingering skepticism, it means structural caution remains extremely high.
The market has placed its bet on policy easing.
And the foundation of this entire optimistic shift.
It relies completely on immediate confirmation from tomorrow's high-impact economic data. If consumer confidence or durable goods contradict the cooling narrative that drove today's gains,
You could see a sudden, sharp reversal.
A very sharp reversal of today's strong conviction. That vulnerability, the one rooted in that breadth-fix divergence we talked about, that is the key risk you need to be monitoring overnight and into the morning.